Response to the crisis. The Federal Reserve floods the financial markets with liquidity, while first the Bush administration and then the Obama administration enact stimulus and bailout packages that now amount to, as best I can make it out, something like $3.6 trillion. Correct responses to the crisis? Did the government do the right thing?
No. Those are easy questions.
All right.
One of the painful things, I mean, you can call anything you want to call it. You can call it a stimulus. All the data indicated it didn't stimulate anything except boondoggles across the country as politicians handed out money to all the special interests that they are interested in pleasing. But for example, when they dumped all this money in the banks, the idea was the banks would then pass that money on and more lending.
Right.
Lending went down. They dumped all this money into the businesses. The businesses reduced their investment. All kinds of money is piling up. There's record amounts of money piling up.
What about GM? Surely that's the one success story. Workers are still employed. GM is now a competitive company again. They're paying back billions to the American taxpayer.
Oh, this is the famous one where we guaranteed them and it didn't cost the taxpayers a dime.
Right.
Yes. It's like going to Las Vegas, and saying, I put my quarter in the machine and out came $100. Yes. Now put another quarter and see if you get another 100.
All right.
And put $1 million in there and see if you get $1 million back. We had the same thing with the savings and loan crisis a couple of decades ago. They said, we're backing the savings and loan industry, we're guaranteeing it, but it's not costing the taxpayers anything. Well, it's not until it fails, and then it costs the taxpayers.
All right. Segment 2, what is to be done now? Fed Chairman Ben Bernanke announced this past autumn that the Federal Reserve would engage in a new round of, quote, I'm using his term, quantitative easing, the so-called QE2. The Fed will purchase, Tom, wipe that smile off your face. This is serious. The Fed will purchase some $600 billion of Treasury instruments to keep interest rates low and spur economic growth. That's Ben Bernanke. On the other hand, we have our colleagues at the Hoover Institution, John Taylor, Mike Boskin, and John Kogan, signing an open letter to Ben Bernanke, which read in part, quote, we believe the large-scale asset purchase plan should be discontinued. The planned asset purchases risk currency debasement and inflation, and we do not think they will achieve the Fed's objective of promoting employment, close quote. Whose side is Tom Sowell on?
Oh, I'm on the side of people say they shouldn't have done it.
Easy, another easy one.
Oh my gosh, yes. There used to be a phrase for this, it was called monetizing the debt. It means that the Treasury Department has deficit spending, so they put out all these bonds that they're selling, and if the public won't buy them, the Federal Reserve will buy them because the Federal Reserve can legally print its own money. So it's no problem for the Federal Reserve to buy them. It's just that what that amounts to is, one, inflation, and two, it amounts to a hidden tax, which will not be confined to the rich, as they call it. I mean, in other words, if you've got X thousands of dollars in your bank account and the Federal Reserve starts printing more money, it is simply stealing the value of the money that you've put aside. So that's the same thing as a tax, only it's an inflation tax.